There's a line going around right now that sounds too good to be true. You can write off your car payment. Here's the honest version. Part of that is real, a real law, real money, and it applies to a lot of people watching this right now. But the number in your head, $10,000, is almost certainly not the number that shows up on your tax return, and there are 5 requirements you have to clear before you get a single dollar of it. I've been a general sales manager for a long time. I structure these deals every day. So let me walk you through what this actually is, what it's actually worth, and the one thing about it that nobody explains. The One Big Beautiful Bill Act, signed in July of 2025, created a temporary federal deduction for interest paid on certain new vehicle loans. That means up to $10,000 of interest per year for tax years 2025 through 2028. Most deductions only help if you itemize. This one is available either way. You claim it on a form called Schedule 1A. And I want to be precise about one word. This is a deduction, not a credit. A credit knocks money off your tax bill dollar for dollar. A deduction just lowers the amount of income you get taxed on. If you deduct $2,000 of interest and you're in the 22% bracket, you didn't save $2,000. You saved about $440. 1. The loan has to have originated after December 31st, 2024. 2. The vehicle has to be new only. Used doesn't qualify. Certified pre-owned is still a used vehicle. It does not qualify. Don't let anybody tell you otherwise. 3. It has to be a purchase, not a lease. If you lease, there's no deduction here, period. 4. It has to be for personal use, and it has to be under 14,000 pounds gross vehicle weight rating. Cars, SUVs, and pickups count. Business vehicles are excluded. They already have their own deductions. 5. Final assembly has to be in the United States. Not the brand, not the badge, where it was screwed together. You cannot assume, you have to check the VIN. 2 vehicles on the same lot, one qualifies and one doesn't. Now let's talk about the $10,000. That's a cap, not a payout. It's the maximum interest allowed to deduct. Almost nobody pays $10,000 of interest on a car loan in a single year. On a $32,000 loan at 6.5%, year 1 interest is about $1,900. Your actual tax reduction, about $418. And it shrinks every single year. That's how amortization works. Early payments are interest heavy, later ones are principal heavy. There's also an income limit. It starts phasing out at $100,000 for single filers and $200,000 for married couples. Okay, this is the part I actually made this video for, the GSM part. Negative equity, rolling old debt into the new loan. The deduction is tied to the portion of the loan that's actually financing the vehicle. It doesn't automatically cover the old debt you carried forward. Your down payment does more than lower your payment. It changes the shape of the loan and affects what portion qualifies. Quick list, things that zero this out. 0% financing, no interest, no deduction, and buying it in a business name. So here's your homework. 1. Check final assembly. The NHTSAVIN decoder is free and public. Do it on your phone before you sign. 2. Keep your interest statement. Starting in 2026, lenders have to issue a specific form, Form 1098-VLI. 3. Ask your tax professional, not your salesperson. If someone on a showroom floor tells you exactly what you'll get back, they're guessing. Look, this is a real benefit. If you're buying new, American assembled, and financing, you should be aware of it. Just go in with the right number in your head. Don't assume, check the VIN. If this helped you, subscribe. That's More Than Sales. I'll see you in the next one.